Well, let's bring in Peter Boockvar now. He's got a look at the economic landscape for us. He's with Bleakley Advisory Group and a CNBC contributor. And Bleakley, Peter, is not, a point of view here, we should emphasize. It just so happens that things don't look that great today, do they?
Absolutely. We want asset prices to rise, not fall.
Yeah. So explain how you think the linkages to today's sell-off work. Is it emanating from China? Are those concerns legitimate? Do you agree with Jim Chanos that it shouldn't have a big effect here? And if so, is it other concerns, just simply market positioning, seasonals, the debt ceiling, et cetera?
Well, first thing, China is a big deal, but as Jim said, possibly just for China. But I don't think it's a coincidence that this is happening right before the Fed is about to taper its asset purchases. The ECB is trimming back on their QE. The Bank of England may mention and start the same on Thursday, and that when that liquidity spigot, even if it just stops not in terms of continuing to flow, but isn't increasing anymore. That I think is a reason to have a gut check on risk. I do think that for investors in the U.S., when they see credit spreads as tight as they are, when they see valuations as high as they are, that what is going on in China could be just a reason to rethink paying below 4% for a high-yield bond, receiving 6% for a CCC bond, which is one grade over default, and that this is a perfect reason for people to start paying attention to valuations and the prices they're paying.
Fair enough, Peter, although it's going to be hard to tell what the quote-unquote right price should be when we can't even figure out what the right price for the benchmark treasuries is. That yield moves around with fundamentals, but the level seems to be divorced from any economic reality, unless you would say that we are in a kind of stagnant growth period for quite some time here in the U.S., and maybe we are. Obviously, if you lose Chinese growth at the margin, that's not going to help anybody.
Absolutely. I think growth concerns are the reason why the 10-year is at 130 and not higher in light of the inflation stats. But there's also growth concerns in the U.S. as we have potentially, a fiscal hangover coming next year, considering that a lot of the money that was spent this year may not be repeated, particularly the government transfer payments that was able to sustain consumer spending. And then I've been of the belief that inflation itself is slowing growth, and that we are in this sort of stagflationary type of environment. And I'm not aware of a time in history when a stagflationary environment leads to higher multiples. It usually leads to lower multiples.
Okay, fair enough. But do you think it's going to persist into 2022? So we're starting to see, especially in Europe, big problems in terms of the government having to help out households with the cost of energy bills. This could get worse, obviously, before it gets better. And then does the issue just go away come 2022?
I think sticky, persistent inflation is going to remain with us for the next couple of years, as supply-side issues aren't quickly cured. Maybe we've topped out in terms of the rate of change in inflation, but we have to remember that all we need to do is go to an inflation rate of 3 to 4% to create its own challenges. I mean, a world of zero interest rates, negative interest rates, tight credit spreads, high debt levels, high equity valuations around the world, that's not a good backdrop when if inflation just slows to 3 to 4%.